Good afternoon, everybody, and happy Friday and happy New Year. Welcome back to the weekly market analysis for the week ending January 5th, 2024. Short week of trading, only 4 days. And it's been basically down in equities and really interesting across markets all week except for today. We'll jump into it in just a moment. And the big question is new year, new markets, and are the bulls exhausted? And we'll jump into it shortly. But first, I'd like to remind you to hit the like button and subscribe to the channel if you have not. You can also find me at Mr. J. Thomason on Twitter. You can also subscribe to my weekly newsletter, which in 2024, one of the new things is I am opening up access to the entire newsletter absolutely free for all subscribers. So if you want to get weekly insights that are much more in-depth than these videos, a lot of qualitative insights and quantitative insights, including positioning charts, tactical signals, overlays, and so on, then go ahead and hit the or go to the links below in the description of the video and subscribe there. You can find the link to my newsletter as well as my Twitter link in the description of the video below. So with that, let's just discuss what's going on in the market right now. And I think what's on a lot of people's minds currently is this pullback that we've seen thus far, is it the beginning of something much deeper, or is it just a small mean reversion or a small correction leading to more upside? And I would say, right now it feels a little uncertain. One of the things that I do in my weekly newsletters is I make a guess about price action in the coming week. And I would say, as things are now, while in my opinion I have a little bit of a bearish lean, I would say the direction of markets is pretty uncertain for the next week, and I have a lot less conviction in downside going into next week as I did, last week and the week before. So I haven't done a video in a few weeks, and kind of what's happened since the last time I did a video, which was back on Friday, December 15th, kind of where the crosshair is right now. One of the things that I've been tracking in my videos as well as in my newsletter the last few weeks ago was that the market was way overbought. A lot of the indicators were screaming that exhaustion was near, that a reversal was due, and the question was just how deep would that be? And a lot of things have transpired since then. From the point where I last made a video, the markets are lower. We did get, the question that I made in my last video was, are we going to get a Santa Claus rally? So the official definition of a Santa Claus rally is a rally that takes place the final trading days after Christmas, and then the first 2 trading days of the new year. So the first couple of days after Christmas were good, and then we've kind of been down ever since the end of December. And so far the scale of this pullback, we're closing only about 2% down. So it's nothing to freak out about. If you're a bull right now, it's 2% is nothing ultimately in the grand scheme of things. If you're bearish, then in theory there is a lot of room to still go down further. But also you have to understand, when it comes to equities, the skew is to the upside, or the data tends to, or the movement tends to skew to the upside. There's upward drift. We've talked about that multiple times on this channel. So on the S&P 500, let's just get our bearings straight as where we are right now on equities. We've got the S&P futures here closing at 43.74. The NASDAQ futures have had the worst of the downturn the last few days, down closing at 16,460 and 25. The Russell also down pretty steeply over the last few days, closing today and closing the week at 1966.8. And then the Dow has the most mild corrective action, really not down a whole lot from its closing high from the end of 2023. It's down less than 1%. So you're getting a lot less volatility in the Dow. Really, I mean, not maybe not so much to the upside, but definitely on the downside, you're getting a lot less volatility. So that's important to note. So anyway, kind of looking at equity specifically, where are the risks, and what's the likelihood that this price action is either going to continue downward or will move back to the upside? So one of the things I want to highlight for you here, a new indicator that I've developed on TradingView here. It's essentially a histogram that's tracking the force of price moves and along with the momentum. And what I've basically done is made this histogram, and it's essentially what you kind of see over time is that when it's not so much the level as much as it is the direction, generally speaking, as well as if the histogram is green or if it's red. And so what you kind of see across time is this does a pretty good job of transitioning to green at bottoms and transitioning back to red near tops. And nothing is perfect, and obviously you can see instances here, like when we had our downturn from the end of July to the end of October, you did see price pop up. You did see the histogram pop up into green, but then it ended up not being an extensive bullish move once that transition took place. And then you also see here, kind of in early July, how we got a red cross on the histogram, but then price still ended up moving quite a bit to the upside before the correction started. So really, it's about the general direction of the histogram, as well as whether or not it's red. So you have to take both of those things into consideration. So, like for example, in this move up since the end of October, what you see is the initial impulse out of red into green, really strong until about mid-November, and then you see it wane a little bit, still green, but waning, and so that's where you saw a lot of that sideways price action. But as long as it was still green, the bias was still to be to the upside, and then we got another push to the upside, and then it started to fall off. And so I developed this because I wanted a different way to illustrate strength and momentum together into kind of like something like a force histogram. And so I think it's actually really helpful, and I've kind of back tested a little bit of this, and it's actually been pretty reliable, not even necessarily on a long-term basis only, but even on a medium-term basis. It has a pretty good record between 1 to 3 months out in terms of direction that it predicts. So right now it's in the red, and it's continuing to the downside, despite the fact that today, like in the S&P futures today, we were up slightly on the day, and despite the fact that my tide indicator generally is bullish. So this is definitely when you see a bullish tide, but then the bearish force histogram. What that's implying is that we're in the middle, obviously, of a counter trend move. And so I would look at this as a correction, or as has the makings of a correction. So that's one indicator that you can look at. But if you wanted to, let me get rid of this on the screen really quick. If you wanted to maybe put a relative strength index up, we've come really well off the overbought condition, and so this somewhat implies that there is room that we could move back up to the upside, although I would say on the NASDAQ, the problem is that we sunk below the 50 level. And just on balance, when the RSI moves to below the 50 level, that indicates a lot of price weakness. And so one thing I would point out just on the RSIs are a little difficult to interpret at times, because they can mean something when a condition is present, and then can mean something completely different when the same condition is present another time. So one thing I would point out is, if you go back to, and I know that this was in the midst of a bear market, but if you go from the period of time in the summer of 2022 where we had a pretty significant move up in the NASDAQ from the June lows to the August highs, we had a corrective moment which brought the RSI back down below the 50 level, got a little bit of a spike, but then price ended up going down quite a bit further after that. And so I would just call out that on the NASDAQ, you're seeing price action super weak, or much weaker than the other markets. You also see the RSI coming down pretty hard on the Russell. Not so much on the Dow, and this is what's interesting. There seems to be a lack of agreement when it comes to the RSI in terms of the different equity indices. So you've got the S&P remaining relatively strong, the NASDAQ relatively weak, and the Dow still really strong. And so that's part of the reason why I developed that force histogram, because it gives a much better message consistently across the board versus like a normal RSI. And so if I show you kind of what's going on here across all the equity indices, the force histogram is showing, and I know it's got the lines there now, I usually have those off. It's showing red and a continued downtrend in red for all of the markets. And so, including the Dow, by the way. So that's helpful, because it kind of shows you that the momentum on this move can and should more likely continue to the downside. Okay, so that's one thing I wanted to point out. I don't know why I just put that up, because I'm getting rid of it again. Why else? What else might suggest the direction of equities? One of the things I look at quite a bit for short to medium term price direction to help in short to medium term price direction is the stocks above their 50-day moving average in the S&P 500. And what's really interesting is the stocks had started their decline earlier at the end of December, but the stocks above their 50-day moving average moved above and closed above the 90 level, despite the fact that we were falling. And I think that's interesting, because given how much, if we go back up to the S&P 500 really quick, from our peak, like I said, we're about 2% down from the peak at the end of 2023. And what's really interesting about that is, despite being down like that, the stocks trading above their 50-day moving average is still pretty near the extremes where we would typically look to see a correction or some sort of corrective action taking place. And so despite the fact that for a lot of investors, and this is what's so funny, and I did this on Twitter, I posted this on Twitter, where I talked about how markets are like people who are drug addicts that can't stand a 1% down move. I mean, we're down 2%, people are freaking out already. That says something. But despite the fact that people are freaking out, there is still a considerable level of breadth in the market that can come off before any sort of correction is over. So that's something that I would point to that suggests that price can continue to go down further. Or I would say that the likelihood of price action moving down is much higher than not based on this analysis. You've also got the decline in the VVIX to VIX ratio, although it did close above its control line. The momentum in this is moving down, despite the fact that you had a boom in IWM over in small caps over mega caps, large caps. Despite the fact that we had this counter trend move, it's coming back down. What would have been super bullish for the markets in the medium to long term would be if we got across, because small caps in a healthy market, small caps should outperform. Given again, not in isolation, not this by itself. So don't put this up on your chart and say, oh, if it's positive, then that means that that the markets are going to be good, and if it's negative, markets are going to be bad. It often is the case, but not always. Like if you look at 2022, most of that year was a bear market, but it was moving sideways and slightly up. So don't take it in isolation, but I'm just saying in the context of the other indicators, you want to see this moving up given the circumstances that we are currently in. And then value to growth, you also would want to see value outperforming growth, generally speaking, in these conditions. And despite the fact that we've moved up, we still have a lot of work to do to get this trend to change. And then high beta to low volume or low volatility, high beta to low beta. I would say this is relatively healthy in terms of it correcting off of this extreme. I would call this overbought. The price movement way above momentum. So this is actually kind of healthy. So this gives credence to the idea that perhaps the rally has corrected enough and can continue back up to the upside, but that remains to be seen. So what I don't like about this is that the small cap to large cap ratio is coming off, but the high beta to low beta ratio has healthily corrected and appears to be establishing a base to continue moving to the upside. And typically, high beta outperforming low beta is going to mean that the market is generally bullish. So there's that. So that kind of changes the interpretation of some of this, and maybe suggests that maybe the correction and the pullback is over. Something else that I would call out, we had over the last couple of weeks, we had a bearish tide cross in the dollar, but then we also had a pretty significant reversal candle earlier this week. And so I have been wondering if the dollar was due for a bounce. The sentiment around the dollar was getting pretty crazy bearish. Everybody in the futures market is getting really bearish the dollar, and it was oversold and was confirming a triple bullish divergence. And so right now the bearish tide has me leaning more bearish, which is generally good for risk assets like stocks. But I'm going to reserve judgment on this until the next week or two develops, because I want to see what happens with liquidity. I want to see what happens with treasury yields and things like that. So we'll see. And next week I think it's on Thursday, we have a CPI release, and so that could say a lot about market direction. By the way, market direction. Today, yields were up despite the fact that the payrolls report, while on the headline number was a beat, all of the underlying data in the payrolls report should have meant that bonds got bid, and they didn't. It also should have meant gold was, and gold did pop. This is pretty wild. Let me just show you some intraday price action. So the yields were up, then they spiked up right before the payrolls data, or right when the payrolls data happened. Then they came off. The ISM data came out at 7 or 10 Eastern time, which also, by the way, that should have sent the dollar sinking and should have caused a bid into bonds, and it did. But then we just got it all back, and the bonds ended positive, like you see the 10-year ending positive in its yield. And so to me, that's a concern. So let me go let me go to my 10-year chart and look at it normally. What I'm concerned about here, and this is just so classic, we were almost certain to get a tide cross, a bearish tide cross, which would have been the first time since May of last year, which you see how that turned out. And if you recall, if you've been following my videos and my newsletter over the last year, back when this crossed bearish, I said, well, it is the first time since back in August of 21, but that didn't last very long. And I'm not saying that this won't cross bearish, but gosh dang, if I didn't feel almost exactly the same way about this bearish tide cross as I did for the last two. That doesn't mean that yields are going to spike again, but I think right now the greatest risk in the market is that yields have bottomed for the time being and are about to make another surge to the upside. And they don't have to make a new high for this cycle. They just have to go up a bunch for things to get really dicey for not just for the bond, obviously in the bond market, but for equities and other risk assets. And what's concerning is if I put, let me just put an RSI up here for just a moment. Let's see, here we go. Yields were oversold. And then we got a reversal candle, as you can see on the screen by this little arrow with an R. You can kind of see it where my crosshair is. And we've been kind of moving to the upside since then. And like I said, the biggest thing for me today is that the data we got today should have been bullish bonds. Bonds should have gone up. The yields should have gone down. And if you just look across the curve, I mean, other than the 2-year was basically unchanged. 5-year up, 20-year up, 30-year up. All of the curves up, which meant that the long end of the curves, so US 10-year minus 3-month, 10-year minus 2-month, and so on, those curves steepened, which means that obviously the long rates were going up more. You would think that the data that we got today would mean that bonds would generally go down, bonds would go up, and that the yields, specifically on the shorter end, would go down rather significantly. But they didn't. And so this has me thinking that we might be in for I don't know if you want to call it a counter trend move, because technically as long as tide is still bullish, this is a bullish trend. We could be in the in the early stages of a new push to the upside in yields, and that would be concerning because that's ultimately going to put pressure on equities, and just risk assets in general, and also gold. So I think that that's something that that's a risk that the markets are not taking into account. Everybody thinks that the peak was here, and everybody thinks that yields are just going to go down. I think the only one who thinks yields are going to go higher is Jim Bianco, who thinks that the 10-year can still go to 5.5. I don't know. I'm not willing to say. That. That's not my base case. But I do think yields can go up from this spot, and I think that sort of action would be bad for equities. So that's another thing I wanted to point out. The other thing I want to point out here along the lines of yields as well is gold. One of the things I keep hearing, this is just kind of a little anecdotal, and if you've been watching this channel, that I go on these rants about gold. I feel like if there's one thing that I've had the pulse on for the last couple of years, it's been gold, and crude oil, but especially gold. And when I'm hearing podcast host after podcast host, YouTube video after YouTube video, where all these people are saying gold is up and no one is talking about it, gold is bullish and no one is talking about it. After a while, like when 30 different people are talking about how nobody is talking about gold being bullish, you're kind of saying the opposite ultimately. And so my point is to say is that Peter Schiff is Peter Schiffing on gold, and everyone is talking about gold. CNBC is uber bullish gold. And to me, that's a signal to go the other way. And it actually turns out that the positioning has gotten a lot longer in gold. And so tons of people are already uber long. And despite that, we got a reversal candle on Tuesday this week. And despite the fact that today we had data that would suggest gold should go up, it didn't. And so I think gold's going to go down. This is just my opinion. And, I could be wrong. I feel like I'm one of the only people who thinks gold is going to go down. But that's what I think is going to happen. And I'm willing to be wrong. I was pretty much right for the entirety of 2023 about gold, save for like 3 or 4 days of price action. And I'm going to take that to the bank. Okay. I think I have a pretty good read on this. I want to see what happens over the next week with CPI, because that can cause a change in the outlook here. But generally, I think something about 2023 that might happen that I think very few people expect is that gold can go back down below 1900. I'm not saying that it will. I'm not saying that that's my base case. Actually, my base case is rather that gold is going to come back down right around this level between maybe 1925 and 1965. Somewhere in that range is kind of where I think gold will come down to. I do think gold will go up to all-time highs and stay there, unlike what it's done the last couple times it tried to break above the all-time high or the previous all-time high. I think it will get up there and stay up there by the end of the year, but I still think it's got to go down a little bit more and shake out some people. Because right now, too many people believe in gold, just the same way that too many people think that like yields are done and are going to go down to like 2 or 3% or something like that. So, and then finally, the last thing I want to say back to yields, specific to yields, we have a problem here because right now the 10-year is at 4.05%. The 20-year is at 4.35%. The 30-year is at 4.2%. And let's ignore the 30-year, at least to the 20-year. 20-year is at 4.35. The Fed has forecasted 3 cuts next year, which if they cut 3 times, puts the Fed funds rate at, what is that? That's going to be 4.5%. And so that's still in the 2-year is largely the 2-year is largely a proxy for where the Fed funds rate is eventually going to go. I like to look at the 3-month yield, but in any case, we have this problem here because my question is and also here the yield curve. The yield curve needs to get back above 0. People are talking about how, the yield curve doesn't signal recession anymore. Maybe. I don't know. I'm not willing to make that bet. I think, markets have a way of making fools of people who think that they know something certainly. I think the risk here is that the yield curve does predict recession and that it's just so late that people basically write off the yield curve and say that it's no big deal anymore. But here's the thing. The banking system needs the yield curve to go back above 0. Needs to uninvert. They need it to uninvert. And the reason why is because they borrow short and lend long. So this is basically the exact opposite of what the banking sector needs. Right? 10s, 2s, inverted. That's something that needs to change. Okay. The question is, how is the yield curve going to go back above 0 so that banks are able to be profitable again? How can that happen? Well, either the long yield has to go up, in which case you're talking about strong economy, you're talking about the Fed not cutting rates, you're talking about a situation where it's a bear steepener in the bond yield curve. And so that would ultimately, basically just like what we were seeing from, July into October, where the yield curve was steepening, but it was bearish. And that was when, where am I at? Where am I at? Okay. That was when long yield, the 20-year went up to 5.4%, basically. So, either that has to happen, or short yields have to fall precipitously much larger than the long yields, and that really only happens if the Fed cuts, and the Fed is going to have to cut more than 3 times. In fact, I would argue they might have to cut, they would definitely have to cut 6 times and possibly more. 6 cuts puts the yield at 3.75, or the Fed funds rate at 3.75. And right now, let's see here. Right now, that would mean for like a normal yield curve, like the long yields would basically have to stay exactly where they're at. And I just can't imagine like the way that the bonds have been behaving during this price action. I can't imagine that the way the markets are moving, that the bonds are just gonna that the inversion is gonna uninvert like normally. And the Fed's only gonna cut that deep if there's a problem, if there's an emergency. So I just can't see a situation over the next year where like what's happening with bonds is super conducive to either the economy, like the banking system, or to the stock market, because this has to uninvert. And I'm kind of fumbling over my words right now because I feel like I'm just repeating myself, but I just want to make that point because there's potential for this to get really crazy. I'm not forecasting like a crisis or anything like that, but something is going to have to give here. And I'm just nervous that, investors are kind of like looking around thinking the coast is clear and kind of letting their guard down. And that just worries me. And that's kind of just like a contrarian bias that I have. So I'm a little concerned about that. But obviously you have to trade the market that you have and the market that's in front of you, not the market that you want or that you think could or should happen. So with that, I'm going to end this long video. Hope you guys had a great New Year celebration and holiday with your families and your friends. Look forward to producing more content for you this year. Hope you have a great day, and I'll see you guys next time.